Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to talk about choosing the right legal structure for your business. We get this question a lot, so I thought I'd spend a little time on this so you can get additional information for your situation. So, choosing the right legal structure is a necessary part of running a business. Whether you're just starting out or your business is growing, it's important to understand the options that you have. For example, partnerships carry a dual status as a sole proprietorship or limited liability partnership, depending on the entity's funding and liability structure. Under an LLC, members are protected from personal liability for the debts of the business if it cannot be proven that they acted in an illegal, unethical, or irresponsible manner in carrying out the activities of the business. Corporations can sell shares of stocks to secure additional funding for growth, while sole proprietors can only obtain funds through their personal accounts using their personal credit or taking on additional partners. So today's topic is for business owners looking to learn more about the different small business legal structures. And choosing the right legal structure for your business starts with analyzing your company's goals and considering local, state, and federal laws. By defining your goals, you can pick the legal structure that best fits your company's culture. As your business grows, you can change your legal structure to meet your business's new needs. So you can see we're planning, whether it's personal and business, it all lends to making good choices. So if you don't have a business plan, you don't have your goals written down, it's gonna be really difficult to really ascertain what would be the best legal structure for your business. So today I'm going to discuss the most common types of business entities and their notable features to help you decide on the best legal structure for your business. So what are the types of business structures? The most common types of business entities include sole proprietorships, partnerships, limited liability companies, corporations, and cooperatives. So let's take a look at each of these legal structures. So the first one, the sole proprietorship. This is by far the simplest form of business entity. With sole proprietorships, one person is responsible for all a company's profits and debts. If you want to be your own boss and run a business from home without a physical forefront, a sole proprietorship allows you to be in complete control. This entity does not offer, though, the separation or protection of personal and professional assets, which could prove to become an issue later on as your business grows and more aspects hold you liable. Proprietorship costs vary depending on which market your business is part of. Generally, your early expenses will consist of simply state and federal fees, taxes, equipment needs, office space, banking fees, and any professional services your business decides to contract. Some examples of these businesses are freelance writers, tutors, bookkeepers, cleaning service providers, and even babysitters. Here are some of the advantages of this particular business structure. Easy to set up. A sole proprietorship is the simplest legal structure to set up. If your business is owned by you and only you, this might be the best structure for your business. There's very little paperwork since you have no partners or executive boards to answer to. Low cost. Costs vary depending on the state you live in, but generally, the only fees associated with a sole proprietorship are license fees and business taxes. Tax deductions. Since you and your business are a single entity, you may be eligible for certain business tax deductions, such as healthcare deductions. It's also easy to exit. Forming the proprietorship is easy, and so is exiting this particular structure. As a single owner, you can dissolve your business at any time with no formal paperwork required. For example, if you start a daycare center and wish to fold the business, you can simply refrain from opening the daycare and advertising your services any longer. So, examples of sole proprietorships. The sole proprietorship is one of the most common small business legal structures. Many popular companies started as sole proprietorships and eventually grew into multi-million-dollar businesses. Some of these companies include eBay, JCPenney, Walmart, and even Marriott Hotels. So the next business structure we'll talk about is the partnership. This entity is owned by two or more individuals. There are two types: a general partnership where all is shared equally, and a limited partnership where only one partner has control of its operations, while the other person or persons contributes to and receives part of the profits. Partnerships carry a dual status as a sole proprietorship or limited liability partnership, depending on the entity's funding and liability structure. This entity is ideal for anyone who wants to go into business with a family member, friend, or business partner, like running a restaurant or an agency together. A partnership allows the partners to share profits and losses and make decisions together within the business structure. Remember that you will be held liable for the decisions made, as well as those actions made by your business partner. The cost of a general partnership varies, but it is more expensive than a sole proprietorship because you want an attorney to review your partnership agreement. This is something I see a lot of people not doing. We absolutely want to have a partnership agreement in place here. The experience and location of the attorney can affect the price range, of course. A general partnership must be a win-win for both sides for it to be successful. An example of this type of business is Google. In 1995, co-founders Larry Page and Sergey Brin created a small search engine and turned it into the leading search engine globally. The co-founders first met at Stanford University while pursuing their doctorate and later left to develop a beta version of their search engine. Soon after, they raised a whopping $1 million in funding from initial investors, and Google began receiving thousands of visitors a day. Having a combined ownership of 16% of Google provides them with a total net worth of nearly $46 billion. Here are some of the advantages of a business partnership. It is easy to form. Like a sole proprietorship, there is little paperwork to file. If your state requires you to operate under a fictitious name or doing business as or DBA, you'll need to file a certificate of conducting business as partners and draft an articles of partnership agreement, both of which have additional fees. A business license is usually needed as well here. Growth potential. You're more likely to obtain a business loan when there's more than one owner. Bankers can consider 2 credit lines rather than 1, which could be useful if you have a less than stellar credit score. So what are the taxation or special taxations included in a general partnership? A general partnership must file federal tax form 1065 and state returns, but usually they do not pay income tax. Both partners report their shared income or loss on their individual income tax returns. For example, if you owned a bakery with a friend and structured the business as a general partnership, you and your friend are co-owners. Each owner brings a certain level of experience and work capital to the business, which can affect each partner's share of the business and their contribution. Let's say you brought most of the seed money capital to the business. It could be decided that you retain a higher share percentage, making you the majority owner. So examples of partnerships. Next to the sole proprietorship, partnerships are one of the most common types of business structures. And examples of successful partnerships include Warner Brothers, Hewlett-Packard, Microsoft, Apple, Ben & Jerry's, and even Twitter. So the next structure we're going to look at is a limited liability company. A limited liability company, or an LLC, is a hybrid structure that allows owners, partners, or shareholders to limit their personal liabilities while enjoying the tax and flexibility benefits of a partnership. Under an LLC, members are shielded from personal liability for the debts of the business if it cannot be proven that they acted in an illegal, unethical, or irresponsible manner in carrying out the activities of the business. This gives you a higher level of personal protection from the business than both the sole proprietor and the partnership. Limited liability companies were created to provide business owners with the liability protection that corporations enjoy while allowing earnings and losses to pass through to the owners as income on their personal tax returns. LLCs can have 1 or more members, and profit and losses do not have to be divided equally among each member. The cost of forming an LLC comprises of the state filing fee, and that can range from $40 to $500 depending on the state you file in. So for example, if you file an LLC in the state of New York, there's a $200 filing fee and then $9 biennial fees. Further, you must file a biennial statement with the New York Department of State. If you file an LLC in the state of California, there's a $70 filing fee, and with 90 days of filing, you have to file your articles of incorporation. The LLC must also file a statement of information and pay $20 for that. In addition, most businesses must also pay in California $800 franchise tax annually. Although some small businesses can be LLCs, some large businesses choose this legal structure. One example of an LLC is Anheuser-Busch Companies, one of the leaders in the U.S. beer industry. Headquartered in St. Louis, Missouri, Anheuser-Busch is a wholly owned subsidiary of Anheuser-Busch InBev, a multinational brewing company based out of Belgium. So what are other examples of LLCs? The LLC is typical among accounting, tax, law, and financial advisory firms, but other types of companies also file as LLCs. Well-known companies include Pepsi-Cola, Sony, Nike, Hertz Rental Car, eBay also has, and IBM. So you can see a lot of large companies use some of the entities we've already talked about rather than incorporation. So that's the next legal entity we're going to talk about today. The law regards a corporation as an entity separate from its owners. It has its own legal rights independent of its owners. It can sue, be sued, own and sell property, and sell the rights of ownership in the form of stocks. Corporation filing fees vary by state and fee category. For example, in New York, the S corporation and C corporation fees are $130, while the nonprofit is $75. In California, the filing fee is $100, and that's to file your articles of incorporation, as well as the minimum $800 annual state tax. There are several types of corporations to consider also, including C corporations, S corporations, and B corporations, closed corporations, and nonprofit corporations. So here's where it gets a little bit more complex, but we're gonna break those down a little bit. So C corporations owned by the shareholders are taxed as separate entities. For example, Morgan Chase and Company is a multinational investment bank and financial services holding company that's listed as a C corporation. Since C corporations allow an unlimited number of investors, many larger companies, including Apple, Bank of America, and Amazon, file for this tax status. S corporations were designed for smaller businesses and avoid double taxation, much like partnerships or LLCs. Owners also have limited liability protection. So an example of an S corporation that operates very simply, employee salaries are subject to FICA, while the distribution of additional profits from the S corp does not incur further FICA tax liabilities. So this is a huge tax benefit here when we're looking at what type of corporation to set up for your business. B corporations, otherwise known as benefit corporations, are for-profit entities structured to make a positive impact on society. The Body Shop has proven its long-term commitment to supporting environmental and social movements, resulting in an awarded B corporation status. The Body Shop uses its presence to advocate for permanent change on issues like human trafficking, domestic violence, climate change, deforestation, and animal testing in the cosmetic industry. So this is kind of a cool thing to know if you are planning to have a business that has a positive impact on society. You definitely get additional tax benefits to be categorized as a B corporation. Closed corporations, typically run by a few shareholders, are not publicly traded and benefit from limited liability protection. Closed corporations, sometimes referred to as privately held companies, and they have more flexibility compared to publicly traded companies. Hobby Lobby, for example, is a closed corporation. It's a privately held, family-owned business. Stocks associated with Hobby Lobby are not publicly traded, but rather the stocks have been allocated to family members for their percentage of ownership. Open corporations are available for trade on a public market. Many well-known companies, including Microsoft and Ford Motors, are open examples of open corporations. Each corporation has taken ownership of the company and allows anyone to invest in the company. Then lastly, in this category, we have nonprofit corporations. Nonprofit corporations exist to help others in some way and are rewarded by tax exemption. Some examples of nonprofit are the Salvation Army, American Heart Association, American Red Cross. These types of business structures have one sole purpose, focusing on something other than turning a profit. So what are the advantages of this business structure? Those advantages include, as we mentioned, limited liability. Stockholders are not personally liable for claims against your corporation. They are only liable for their personal investments. Continuity, this is a huge one. Corporations are not affected by death or the transferring of shares by its owners. Your business continues to operate indefinitely, which is preferred by investors, creditors, and consumers. This is a huge reason to establish this type of entity if you want it to go on after you. And capital, it's much easier to raise large amounts of capital from multiple investors when your business is incorporated. This type of business is ideal for businesses that are further along in their growth rather than a startup based in a living room, for example. If you've started a shoe company and have already named your business, appointed directors, and raised capital through shareholders, the next step is to become incorporated. You're essentially conducting business at a riskier yet more lucrative rate. Additionally, your business could file as an S corporation for the tax benefits associated with it. Examples of corporations. Once your business grows to a certain level, it's likely in your best interest to incorporate. There are many popular examples of corporations, including General Motors, Amazon, ExxonMobil, Domino's Pizza, and P. Morgan Chase. And then lastly, the last entity we're going to talk about is the cooperative or co-op. The co-op is owned by the same people it serves. Its offerings benefit the company's members, also called user owners, who vote on the organization's mission and directions and actually share in the business's profits. Advantages that cooperatives offer include lower taxes. Like an LLC, a cooperative doesn't tax its members on their income. Increased funding. Cooperatives may be eligible for federal grants that help them get started. And discounts and better service. Cooperatives can leverage their business size, thus obtaining discounts on products and services for the members it serves. Forming a cooperative is complex, though, and requires you to choose a business name that indicates whether the co-op is a corporation, such as incorporated or Inc. or limited. The filing fee associated with co-op agreement varies by state. New York, for example, for an incorporated business is $125. An example of a co-op is CHS Inc., a Fortune 100 business owned by U.S. agricultural cooperatives. As the nation's leading agribusiness cooperative, CHS recently reported a net income of $829.9 million for the fiscal year ending August 31st, 2019. Other examples of cooperatives are Land O'Lakes, Navy Federal Credit Union, Welch's, REI, and even Ace Hardware. So some of the takeaways, the five types of business structures are sole proprietorship, partnership, limited liability, company, corporation, and cooperative. So choosing the right structure depends largely on your business type. And as your business grows, you will be able to switch structures to meet your future needs. So factors to consider before choosing a business structure. For new businesses that fall into two or more of these categories, it's not always easy to decide which structure to choose. You need to consider your startup's financial needs, risk, and ability to grow. It can be difficult to switch your legal structure after you've registered your business, so give it careful analysis in the early stages of forming your business. Here are some important factors to consider as you choose the legal structure for your business. You should also plan to consult with your CPA and financial advisor for his or her advice. Flexibility. Where is your company headed? And which type of legal structure allows for the growth of your company and how you envision it? Turn to your business plan to review your goals and see which structure best aligns with those objectives. Your entity should support the possibility for growth and change, not hold it back from its potential. Consider complexity. When it comes to startup and operational complexity, nothing's more simple than a sole proprietorship. You simply register your name, start doing business, report the profits, and pay taxes on your taxes as personal income. However, it can be difficult to procure outside funding. Partnerships, on the other hand, require a signed agreement to define the roles and percentages of profits. Corporations and LLCs have various reporting requirements with state governments and the state governments and the federal government. Consider liability. A corporation carries the least amount of personal liability since the law holds that it's its own entity. This means that creditors and customers can sue the corporation, but they can't gain access to any personal assets of the officers or shareholders. An LLC offers the same protection, but with the tax benefits of a sole proprietorship. Partnerships share the liability between the partners as defined by their partnership agreement. If you don't have a partnership agreement in hand or in place, that can lend to some complications later on. Taxes. As an owner of an LLC pays taxes just as a sole proprietor does. All profit is considered personal income and taxed accordingly at the end of the year. As a small business owner, you want to avoid double taxation in the early stages. The LLC structure prevents that and makes sure you're not taxed as a company, but as an individual. Individuals in a partnership also claim their share of profits as personal income. Your accountant may suggest quarterly or biannual advance payments to minimize an end effect on your return. And this could be very important. You don't want to get stuck with a tax bill at the end of the year. This happens a lot when people have a really good year and they forget to plan for the higher tax consequence that's going to occur. Good problem to have, but still have to plan for it. A corporation files its own tax returns each year, paying taxes on profits after expenses, including payroll. If you pay yourself from the corporation, you will pay personal taxes such as Social Security and Medicare on your personal tax return. Control. If you want sole or primary control of the business and its activities, a sole proprietorship or an LLC might be the best choice for you. You can negotiate such control in a partnership agreement as well. A corporation is structured to have a board of directors that makes the major decisions that guide the company. A single person can control a corporation, especially at its inception, but as it grows, so too does the need to operate it as a board-directed entity. Even for a small corporation, the rules intended for larger corporations, such as keeping notes of every major decision that affects the companies, those things still apply even if you're a small business. So, little tip, important factors to consider before liability, tax structure, and industry regulations. By making a list of specific attributes about your business and its founders, you can choose the right business structure for yourself and your business. Consider capital investment. If you need to obtain outside funding, such as from an investor, venture capitalist, or bank, you may be better off establishing a corporation in this case. Corporations have an easier time obtaining outside funding than sole proprietorships. Corporations can sell shares of stock and secure additional funding for growth, while sole proprietors can only obtain funds through their personal accounts, using their personal credit, or taking on partners. An LLC can face similar struggles. Although it's its own entity, it's not always necessary for the owner to use their personal credit or assets. You can't establish credit with your LLCs. Licenses, permits, and regulations. In addition to legally registering your business entity, you may need specific licenses and permits to operate. Depending on the type of business and its activities, it may need to be licensed at the local, state, and federal levels. States have different requirements for different business structures. Okay, depending on where you set up, there could be different requirements at the municipal level as well. As you choose your structure, understand the state and industry you're in. It's not a one-size-fits-all, and businesses may not be aware of what's applicable to them. The structures discussed here only apply to the for-profit businesses. If you've done your research and you're still unsure which business structure is right for you, you should speak with a specialist in this area, including asking for help, taking advantage of our complimentary consultation. That's one of the areas we help businesses set up properly so that they can use their business as a tool to generate and build personal wealth as well. So people ask all the time, when should I incorporate my business? So we'll look at additional key factors to consider this question. So from intellectual property to personal liability, incorporation protects against biggest risks of entrepreneurship, but it does come at a cost. For entrepreneurs struggling to break even, the timing of incorporation is everything. Incorporate too soon, and you may pay fees long before your startup earns its first cent. Wait too long, and you risk losing your intended business name, your intellectual property, and even your assets. I'm going to detail several considerations that you should keep in mind when determining your company's incorporation timeline, and why early incorporation is almost nearly better to consider doing it earlier than later. Okay, so the earlier the better. Early incorporation is advisable for many startups. Complications such as splitting among co-founders and handling questions of sweat equity are best dealt with officially through incorporation. The following are just a few indications that the time to incorporate is now. So, establishing a co-founder relationship. Co-founder issues regularly derail otherwise promising business ventures. Fellow founders may disagree on equity split and other issues. Early incorporation can reduce these qualms, ensuring that co-founders see eye to eye from the very beginning. Promising sweat equity. As a startup, you may lack the funds needed to pay your employees the rate they deserve. However, you have faith that if they remain on board, they will be rewarded handsomely in the future. If you intend to reward your current employees or co-founders via sweat equity, it is imperative that you incorporate. Impressive promises of future shares are difficult to enforce without an ironclad guarantee of incorporation. Protecting intellectual property. This is often referred to as the secret sauce of business ownership. Intellectual property sets your company and your competitors apart. Intellectual property is best protected through incorporation, particularly if you have founded your company with a business partner. If after avoiding incorporation, your partner leaves, then you risk that person using your intellectual property for a competing venture. However, while early incorporation could prove valuable, many startups wait to incorporate until after they have registered intellectual property rights. Okay. Third-party funding. It's an exciting time when you have an early investor who can help your company off the ground. But if you're not yet incorporated, you will not be able to take advantage of your investors' funds. However, corporation structure may matter more than the timing in this case when you're talking about getting capital for your company. Anticipating acquisition. Not all entrepreneurs are in it for the long haul. Some launch businesses with the express desire to eventually be acquired by a larger corporation. This approach is particularly common among today's app developers, many of whom wish to enjoy the benefits of long-term capital gains taxation and avoid the high taxes ascribed to ordinary income. Unfortunately, this is not possible until the company's founder has held stock for at least 1 year. In other words, early incorporation is essential. Ideally, founders aiming for eventual acquisition should incorporate before the app is even developed, for example, and definitely before the app is ready for beta testing. This will ensure quick turnaround, allowing for successful acquisition while the app remains relevant. Protecting personal liability. Of course, this is one that most people think about when they're looking to go from a sole proprietorship to incorporation. For many entrepreneurs, the chief argument in favor of incorporation is personal liability. If your startup encounters significant challenges, incorporation will allow you to rest easy, knowing that your personal property remains safe. If you avoid incorporation, your assets, including your savings, real estate, even your vehicle, could be at risk in the event of a lawsuit. As a sole proprietor, you are personally liable for all debt and any business-related activities, including problems. So, incorporating before the startup's launch. For some entrepreneurs, early incorporation is not good enough. Many startups begin the process long before their business commences operation. There are definitely merits to this approach. By highlighting expectations and obligations right away, founders can avoid the types of problems that famously plagued Facebook and other co-founded startups. Pre-formation incorporation is ideal if you have a clear vision of your company's future. You are currently making plans with co-founders, employees, investors, and other parties. You believe your intellectual property may otherwise be at risk, and you can realistically handle the cost of incorporation in addition to other expenses. So, when to hold off on incorporation? Most companies benefit from incorporating as early as possible, but there are always exceptions, most of which involve sole proprietorships who do not intend to expand their business. The following signs may indicate that it's best to hold off on incorporation. So, for example, if it's a casual business ownership, minor businesses that primarily serve as, say, side hustles may not require incorporation, which can potentially constitute a frivolous expense. If you primarily regard your business as a hobby, you may gain little from the hassle of incorporation. This is especially true in the future. Piercing the corporate veil. A seemingly sinister term, piercing the corporate veil occurs when courts hold shareholders personally liable for a corporation's actions. This is particularly common when, despite being incorporated, a business is not actually run like a true corporation. Casual business owners who fail to follow established protocol or local regulations risk losing their assets despite having gone through the effort to incorporate. If you in any way doubt your ability to run your sole proprietorship as a corporation, then incorporating is not right for you at this time. Financial considerations. When it comes down to it, most people who decide not to incorporate immediately or ever cite financial concerns. Although incorporation can deliver numerous financial benefits, it may come with a steep upfront price tag, plus ongoing maintenance costs. Mistakes or missed deadlines may elicit more severe consequences following incorporation. A Forbes opinion piece cites numerous instances of entrepreneurs facing well over $10,000 in IRS interest and penalties due to simply late filings. Although late filing is also problematic for sole proprietors, the sheer volume of necessary records make missed deadlines far more likely for incorporated entrepreneurs. Lastly, severe risk of going under. If the future of your business is uncertain due to severe financial issues, the money you dedicate to incorporation is probably best spent improving your operations. After all, advanced planning for your share in your startup will provide little solace if your company is at immediate risk of going under. Ultimately, you will need to weigh the cost of incorporation against the risk you can face if you do not incorporate. This could be well worth the cost either way if you look at the legal actions that you are exposed to. Reassessing the timing of incorporation. Incorporation may not presently be the best option for your business. That does not necessarily mean, however, that it will always be a bad idea. As your venture evolves, take stock of your situation and whether it merits incorporation and any company legal documents that are necessary. Okay, the following signs may indicate that it's finally time to incorporate. So here are some of the when should I if you're not sure. So as a general rule, your profits exceed 100,000. If you have transitioned from a don't quit your day job line of thinking to full-on entrepreneurship, then it may be time to incorporate, especially if you shifted priorities and they've resulted in greater profits. As a guideline, I usually recommend incorporating as soon as your net business income reaches 100,000. Remember, I said net business income. So this is income after expenses. At this point, proper tax planning can drastically reduce your tax liability, but only if your business is incorporated. The next is you're ready to hire an employee. As a sole proprietor, you only have yourself to worry about, and perhaps you disregard the personal liability risk of not incorporating. This all changes the moment you hire an employee and develop an independent contractor agreement for a long-term contract. Now you must consider the future liability of not only yourself, but also your future employees. Ideally, you will complete the articles of incorporation before you draw up an employment contract or employee confidentiality agreement. The next is you want to take out a loan. You may take little interest in investor activity, but even taking out a loan can be difficult if you lack incorporation. You may have been able to get by loan free in the early stages of your startup, but if you later determine that you need money to borrow money for business purposes, you will find it far easier to do so if you seek incorporation first. As an incorporated entity, you no longer need to rely solely on your personal credit. This is a huge benefit. The next is concerns from customers and manufacturers. Manufacturers, distributors, and even customers are well aware of the risk of avoiding incorporation. If you fail to incorporate your business, they may sense recklessness on your part. If your refusal to incorporate begins to harm your relationships with manufacturers and other parties, it may be time to reconsider. So if you decide you are now ready to incorporate, what's the best day to incorporate? So for most, it's January 1st. Whether you've chosen to incorporate early or hold off, timing will continue to play a significant role when you finally pursue incorporation. For many entrepreneurs, one date alone is ideal, January 1st. If you incorporate on any other day, you risk dealing with multiple tax returns due to your separate periods as a sole proprietor and as an incorporated business owner. Unfortunately, the incorporation process takes far longer than one day. Once you've submitted the necessary documents, you can expect to wait between 1 and 2 months before you make your S or C corporation or LLC official. During that time, you'll suffer the ill tax effects of sole proprietorship, plus the prospect of a second tax return. Thankfully, there is a roundabout way to take advantage of that desirable January 1st incorporation date, and that is delayed filing. Okay, so how does delayed filing work? With delayed filing, you can draft your company's articles of incorporation and other necessary paperwork ahead of time, but delay the actual date of incorporation to January 1st. Any date of delay is possible with this approach, but most entrepreneurs favor the first day of the year. This approach is best if you begin to consider incorporation around October or November, as you can promptly complete necessary legal forms and then wait for January incorporation. If, however, you express interest in February and March for incorporation, then the tax expenses associated with remaining a sole proprietor may be of greater concern than the inconvenience of filing multiple returns. Delayed filing is ultimately most beneficial for businesses not yet in operation or eager to avoid extra paperwork. So lastly, no matter your stance on incorporation, it is important for you to at least consider it early on. Delays are common, so the sooner you make a decision, the sooner you can develop an accurate vision of your company's future with or without incorporation. Ultimately, timing will depend on how serious you are about your business. The involvement of co-founders, employers, or investors, and your company's tax situation will play an important part here. And of course, as always, we're here to help. So if you're still not sure after all this information, and that could be likely, then take advantage of our complimentary consultation, and we can help you go through the pros and cons of each of these entity structures and the timing of putting those in place for you. I hope this information was beneficial. My name is Jamie Fleming, and I will see you next week on Friday's Focus on Finances. Bye, everybody.